One of the biggest reasons why traders fail is not because of lack of strategy, but it is lack of emotional control. Revenge trading happens when a trader takes trades and end up losing and immediately feels the need to win back the money. So instead of following the plan, they start trading based on frustration, anger, and desperation. So in this short episode, I'm gonna be discussing and covering how to stop revenge trading forever, and this is how I did it. And if you can follow the same blueprint, this can set you free from this problem of revenge trading. Majority of accounts blown by traders, even in prop firms, are always as a result, of always revenge trading. We cannot accept losses. So I'm gonna go through 5 steps. That's acceptance in terms of loss. We're going to be talking about also checklist, which was a game changer for me, and also a daily loss limit plan. And we're going to be talking about taking a break after consecutive losses, and my final, which is like my secret. If you take a look at my TikTok account, me posting signal, not really signals, but the trade that I usually take presently, they they always happen in limit orders, and this has really helped me because now. But we're going to dive into that. So that being said, my name is Rock Calvin, and welcome to Question Trading. So we're going to begin by first accepting the truth. So what is the truth? The truth is that losses are normal and part of trading. So if you see somebody always posting profits, and like they're always winning, they don't show you the other side of it. Just know that that person is faking it, and they don't want to see you the negative side of trading. Which the truth is that no matter how good your strategy is, guys, I've tried it all. I've tried quantum trading. I've tried logarithmic type of trading. I've tried the mathematical side of it. I've tried all this GAN, ICT, SMC, support, resistance, patterns, head, shoulder, double tops. The real point is that all these concepts do work, but none of them will give you 100% strike rate. And when one is working, the other one is not going to be working. So if you say, okay, what if I learn, for example, SMC, ICT, and then and also learn, support and resistance, learn breakouts, then you're going to be using them in terms of conferences. Okay, they're going to be contradicting each other. Mostly because SMC is going to be telling you we get liquidity over here, then. On the other hand, retail concepts are going to be telling you like whoever breakout. On the other side, I'm going to be having maybe quantum system or maybe logarithmic. Logarithmically. Sorry, logarithmically. Oh my goodness, today I don't know what's up with me. Logarithmically, telling you that you're supposed to be doing the opposite of whatever this other concept telling. So the more you know, the bigger the pitch you're digging yourself. That's why you see majority of traders who are really successful haven't really switch strategies. They stick to one thing, and this is something that took me long to to understand, and it cost me a lot of money. So let's dive deep into accepting the loss. Accepting loss is a part of the business because you see, a single loss does not define your skill as a trader. It is just simply the cost of doing business. You have to accept. There's a book I read about um, what is the name of this book? There's this famous book about trading. I've forgotten the name, but it is written by Mark Douglas. How can I forget the name of this book? But yeah, uh, you guys know what I'm talking about. So that book also talks about accepting the risk even before placing the trade, because if you can't accept what you're risking, then definitely that 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 reaction or that action simply means that you have so much need to win, like you're trying so hard to be right, and you're not caring so much about the other side of probabilities of trading, that this can also lose. So if you just accept a lot, a loss, even when you place a trade, you just accept, okay, this 1% is gone, I don't care. That's gonna really will be a game changer for you. Then also, when you go to the second part, which is very important, a checklist. A checklist. This is most of us or most of our traders, we hate boring stuff, or like majority of people, we hate boring stuff because see, trading is very boring. The profitable one. Forget about the one that you have to click buy sell like all over the place. But I'm talking about the real one. The real one is very boring, I tell you, because you feel like you're doing nothing. And you see, the way we've been programmed ever since we were kids, and until we became adults, we always have this need for doing stuff and need for you know pressing up and down, so that we can feel that we're doing something. But if you have a checklist is so boring, because every day you have to read what do you look for. First of all, if it is liquidity, looking for liquidity, marking them out. For example, daily swing highs and daily swing lows, we mark them out. We map them out as an example, like right here. This was a range in between this zone. So we had this swing high right there and this swing low. So price attacked the one above. Now it's dropped. Now we've attacked the one below. But the way we are going to be closing here is really going to depend on whether we are going back or we are continuing to go lower. So in terms of checklist, so you're going to be following your rules. For example, your checklist number one, analysis checklist. It's good to have analysis checklist and entry checklist. I usually do have both of them. So with analysis checklist, what are you looking for? Are you looking for bias? That would be the first thing. So for example, your first thing will be looking for bias. After bias, what else do you look for? You look for liquidity pulls. After looking for liquidity pulls, what else do you look for? You look for, for example, inefficiencies or PD arrays. Mark them PD arrays. And what else? Just this can be just an example of a checklist. So you're looking for bias. First of all, are we bullish or bearish in terms of daily time frame or in terms of order flow? Are we creating lower lows or higher highs? And liquidity, do we have any liquidity in case we want to go down? We gotta take some liquidity up there before we drop down. Do you have any liquidity that you can mark? What about PD arrays? Do you have something like fair value gaps and so on? So this is having a checklist that you know exactly what you're looking for every day. Even if you know for sure that you've already crammed this, you don't have to. You don't just say, like, I've already crammed this, so I'm gonna assume and just always read it. This is the mistake I did, and it cost me money. Trust me. So you have to come here every day and read that checklist. It's boring, yeah, I know, but read the same thing. Just follow the process. Then apart from that, have a daily loss limit plan, because you see, you can't really blow an account if you have this in check. Daily loss limit. So create a daily loss limit plan that's gonna keep your account alive. For example, you can have like if you lose 2% of your total capital, let's assume this is a prop farm account, then you're just done for the day. This works better, and this is what majority of traders use. And they also, I use this. If you lose 2%, walk away. That is non-negotiable. You lose 2%, walk away. Then come back, the next day, with a clear mind. So when you add this, having this daily loss limit and having this a well-written plan, like trading plan, which is the checklist, this is going to really push you to the next level. So apart from that, we're going to be talking about taking breaks after consecutive losses. This is kind of underrated because people don't see the power in it. You always feel like, I still want to go on because opportunities are going to come. But you see, just imagine you've taken losses for the week. First day 2% down, second day 2% down, third day 2% down. We're talking about 6%, assuming that you've not scaled down your risk in a manner that once you've lost 5%. Now you put your loss, daily loss limits to 1%, meaning that you're risking 0.5 per trade, assuming that you take 2 trades per day. So you're going to be losing 1%. So imagine if just 1 week takes you down, like let's say, for example, 5%. It's very, very advisable to walk away for that week. Taking this break is very important because even 5-10 minutes away from the screen, after loss, and maybe you're seeing price is likely to give you another entry, is very important because that will help you regain emotional control and prevent impulsive behaviors. But if you just lost money and you want to get back immediately, that is revenge trading right there. That's revenge. So whenever you lose, you just walk away. Taking a step back will give that strength to be able to make conscious decisions that are gonna keep you still in the game. So the last one, which is my favorite one, which is very, very, powerful to me, like setting limits. I have this guy called Alex G. I think most of you know this guy, Alex G. Alex G have this theme of set and no set and forget. Yeah, he always talk about set and forget, and yeah, that's his thing. But I don't really work with set and forget because Alex G is more of a swing trade and more of a day trade. So we kind of differ on our type of trading. Even I trade patterns and support system. I don't read those things, but I like his this philosophy that he has of about set and forget. Set and forget is just once you're in that trade, you cannot determine the end result, whether you lose or gain. That you cannot determine because sometimes things happen. Trump is going to be talking out there. Russia and Ukraine are going to be having issues, and the same thing Iran with Israel and so on. And when these people they have this these geopolitical factors, if you keep watching, they're gonna aggravate you into doing something stupid that you are not planned, because you'll start seeing that that volatility, and you'll be like, okay, maybe after being stopped out. So working with the limit is way better. So for example, limits do work well if you have a strategy that is I could call it more like a little bit involves mathematics or maybe quantums and so on. And it works way better. For example, sometimes I do calculate, asking myself how far. For example, I know this liquidity up here. This is a swing high, good. Above it, we have a PD rate that's a bearish, fair value gap. Just prior to it, we have a swing low that was displaced. That gave us this gap. You see how price displaced here. Let me give you guys some of my few secrets on how I usually, do this thing. So, for example, if I mark this fair value gap, for example, this one right here, let's give it red. You see it? Down here, we had a liquidity. Liquidity simply means that there are some people who had bought gold from this point, and they were targeting gold to push towards maybe this peak area or this swing highs, right? And after buying maybe from somewhere around here on lower time frames, like maybe hourly, remember this daily time frame, they put their stop loss right here. Remember, what this algorithm is usually looking for is liquidity. It's looking for money. So what the big banks and the big institutions do is that they know, like they don't even have to see, they know, like the algorithm knows, and what the algorithm wants is to trick people. So once it tricks you, especially if you know how to read price, they sweep you out, then the smart ones now engage in. So you see this displacement that happened here on Friday, and I'm pretty much sure this Friday there was something going on in US, especially with Iran and so on. This, go and take a look at your calendars on June 5th, and you'll definitely see that there was something going on. That's why we had this massive push here. So you'll find that geopolitical factors or fundamental factors aligned with technical side. So if you zoom out on hourly time frame or maybe lower time frame, you'll see that there was signals for this thing to happen, to push lower. So assuming somebody put their stop loss right here, they were stopped out. So me, when coming the next week, for example, this Monday, how do I approach this? And I think I gave you guys this analysis. I remember this week I told you guys, like, I'm expecting a PD rate to be formed a gap, and it formed exactly, because Monday we closed back in. Tuesday we just took Monday's highs, then we dropped massively lower. And I told you guys that this was our next point of interest. There's a video about this, about really, like, I did this analysis for you guys, I think sometimes back. So if this happens, the first question is, how did you displace below this swing low? This is not liquidity sweep. This is not liquidity sweep. Most of you will say, like, okay, now since you've taken some, there's sell side, right? Some sell side liquidity right here. Now we're definitely going for for the buy side. But unfortunately, if you pay close attention, we displaced below it, creating a gap. What does that tell you? Price is interested in something down here. And after creating that gap, as you can see, we kept on going lower, and opening this Monday, this one here, price just went back up there. This was last week, you know but it was kind of heavy in pushing lower rather than going upside. So it was very, very, like it wanted to really go down. That's why we never had even, price reaching, to the consequent encroachment of that bearish gap. And you see, Tuesday we closed back in. Wednesday comes and manipulates again. Then we have now this drop coming all the way down. Even this week when we opened this week, it was on Monday. This Monday when we opened here, what did price do? We opened right here, but there was a gap here, a very tiny one. Let me show you guys. Here it is. There was a tiny gap here. If some of you are paying close attention, because if you don't mark these things out, take a closer look. When we opened on Monday this week, the first thing market did was to trick people that were bullish, but unfortunately it was just going to tap some liquidity there. Filling that gap, then we drop down. Tuesday comes in, open right here, and we just proceed dropping. Today, Wednesday, it's the same thing. And now we've touched the 3,000 finally. We're in the 3,000 zone right now, and I'm expecting a little bit push to the downside, but now anything can happen here for sure. Anything can happen. I'm expecting we might end up, tapping 33, but we might just not. Right now, I can't really, promise what's really gonna happen, but yeah, just trade the flow. If you get a bearish, setup on lower time frames, go with it. Not until now we violate by creating some market structure shifts and so on. So this is just to show you guys having a limit is good. So limit in terms of you've done analysis and you're sure that okay, I'd like this market to come back to maybe retest maybe this fair value gap. So let's assume you're a swing trader. This one we're gonna do. This is what we're gonna do. We displaced here, creating this bearish gap. So we're not sure if it's gonna fill it, because as much as you have this breaker here, this is what I call breaker. This is some of my secret, things that I use in trading, because I would even grade this wick from this low to the high of that wick right there. I would grade it and see how price react to them on lower time frames and so on. So you definitely say, okay, I'm gonna sell it from here because I'm swing trader, and then you put your stop loss right there, up there. Then what are you gonna be targeting? You're gonna be targeting this low, just something like that. That's where you want to do. So this takes sometimes a couple of days here, but as you can see, delivered. So instead of waiting to enter this manually, you've done analysis, you know what's happening. So what you do, you put your sell limit right there, stop loss right there, and put your target. So you don't watch charts, you don't watch them. Like me, I avoid that thing like a plague. It has messed me big time, because the moment you starting watching it, like that's how you start this thing they call analysis paralysis, whereby you start feeling like, oh, maybe it's wanna go, it wanna go up. But remember, your first original analysis is always king, no matter what. The first one is always the king. If you start having second thoughts, then definitely you're just you have that paranoia of not wanting to lose. So you put your limit right there, stop loss in place. Then the only thing you can do is not put another limit, another alert here. For example, add click on that alert right there, like that. I create alert right there. So just something like that. So once price reaches here, I know that price that has reached target. So I can only open to see, was I tapped in? If not, and it has reached target, I go and delete my order. So this is how you can stop range trading, and this is just part of the plan. But above all, you must have, first of all, having a good trading plan, and it's never about the strategy. It's always most about psychological, human psychology, and our emotions with anger, pride, ego, not accepting a loss, and always trying to fight back. And unfortunately, you're fighting a machine that doesn't even care whether you win or lose. So that being said, this is fight. So I'm gonna see you guys in the next one.